Today we're going to talk about a brand new spanking. Hey everyone, Steve here from the LMND, a channel where we talk about lucrative but sound investment opportunities and strategies based on requests from the community. Today we're going to talk about a brand spanking new IPO, LMND. We're going to talk about the core business value, why this company went IPO, and then we're going to talk about objectively how it might make sense as an investment. To do that, we're going to break it down into 3 key checkpoints that I use to figure out whether a company makes sense as a tech IPO. So, if this is the type of content you've been looking for, please hit the like button and let's get started. LMND is essentially trying to evolve the existing insurance business, and they're starting it off with a home and rentals insurance segment. Ultimately, what they do is they pull everyone's premiums together, and if someone needs to file a claim, it withdraws from that pool, and LMND makes 20% on top. Anything that's left over every month, they'll donate that money. So for example, last year, they donated about $600,000. It's also worth noting that they leverage reinsurers. So essentially, if the claim is too high, they leverage these reinsurers to do the payout so that they're not over-leveraged themselves. The question, though, I couldn't find the answer to is whether they use reinsurers for all claims or only the really expensive ones. If you know, please leave a comment and let the group know. But ultimately, that's how the business functions. One additional thing to note is that they're funded by premium VCs, SoftBank and Sequoia, and this allowed them to spend a shit ton of marketing dollars to create an explosive growth that allowed them to become a unicorn to go IPO. The question, though, is if they didn't have a shit ton of marketing dollars, like, are they creating brand love, or are they gonna constantly be needing to spend a lot of marketing to grow? Because one approach is a lot more sustainable than the other. For you and I as an end user, this means that on average, you're gonna have a lower premium, and also you have this feel-good moment that your company is also donating your money. So the first checkpoint you wanna look at when you're talking about a tech business is, are they a disruptor? This is especially important if they're going into a segment where there is already a ton of established billion-dollar players, right? Multi-billion-dollar players. If they are a disruptor, then there's a huge upside. Like, for example, Salesforce was a disruptor. Alternatively, if they're not a disruptor, then they're basically trying to get into a market by throwing a lot of money behind it, and that might not particularly work out. So one of the things that this company has pointed out is that 90% of their business, 90% of their existing user segment are first-time home and rental buyers. That to me means that they're not disrupting the existing business. They're not convincing people like me to switch my insurance, right? They're basically convincing people who don't have insurance, saying that you get a better value here, and that makes them sign up. That might not necessarily be a bad thing, though, because old people die off. So if they're actually capturing more of the younger user segment than the bigger businesses, then eventually they're going to own more of the market. So that is one particular concern that might have an upside, it may not. The second checkpoint is, are they going to be an explosive business? Is there a lot more market cap to capture? If we look at their existing business, the home insurance market is a size of about $100 billion, the size of the market. And auto insurance is about 3 times that. Currently, they're only doing home and rental insurance. And on top of that, they're not even in all of the places, not all around the world, not even all the United States. So one of the reasons they're going IPO is to scale up, like most companies. If they go into the auto insurance business and then they open up home and rentals to the rest of the market as well, then potentially they have at least a 3x top line growth potential. One additional thing to note, though, is that in the auto insurance business, there's going to be a higher frequency of claims, right, as opposed to home insurance. So you might imagine that they probably need a larger critical mass before they can make money, just in general. And on top of that, they probably need better customer support for this entire experience as well. So an easy way to look at this is that, let's say you are the business and you signed 100 college students to use your auto insurance, and 10% of them ends up hitting a Ferrari. Okay, so that's 10 people hit a Ferrari with their Civic, and they're paying, let's say, $50 a month, which is pretty high for a Civic, I think. But let's say they're paying $50 a month. They are making you $5,000 a month. You hit 10 Ferraris, and suddenly you're out of the pocket $100,000, $200,000, right? So it depends on how the back end set up, like how the reinsurers pay out and stuff like that. But ultimately, if they had 1,000,000 auto insurances, right, off of $50 a month on average, then they're making millions of dollars a month. And at the same time, if 1% of them decide to hit Ferraris, you're still going to be making a ton of money. Another good example to look at is Obamacare. Obamacare is supposed to be health insurance for everybody. If they can sign enough people, then it's going to be cheap and good for everybody. But instead, there's zero cohesiveness. Everybody's doing their own shit. A bunch of people fell out, and that's why the premium's going up as well. So either the premium has to go up because they can't reach the critical mass to cover the difference, or they're going to go out of business. All right, the last checkpoint I want to talk about is how big is this company's moat compared to its competitors. One prime example is Motif. It's a fintech company that was trying to create a new approach in ETF investing. And the problem is, it was a great idea. A lot of my friends were using it because they love this concept that, if you want to invest in shoes, you don't have to find which stocks are good for shoes. You basically find a package of stocks, a pre-packaged set of stocks that are involved in shoes, manufacturing, sales, all that type of stuff, so that you're somewhat diversified, but you're investing in a concentrated segment of what you think might grow, right? It's a great bloody idea. I like that idea a lot as well. Problem is, Schwab liked it too, stole their business, copied it. Now Motif closed their business like 2 months ago or something like that. So that is a prime example of not having a moat that's big enough, and you're basically challenging billion-dollar players. I pose to you this. If Progressive tells you that they have an internal donation program where they donate hundreds of millions of dollars every year, and that whatever Lemonade has to offer, they will price match, will you switch? If you are a new insurance seeker, will you go with Progressive, a known company with a known background and claim service, or essentially a startup that just went public? That is a real question to ask yourself. As far as I'm concerned, their moat is the price difference. And a billion-dollar company can throw money at the problem, and that to me is too concerning. For me personally, I would not invest in this IPO because I feel like based on the amount of revenue they're currently generating and the amount of marketing they're spending to create growth, I'm concerned by all of this. But there's actually a more superstitious reason for why I won't invest in Lemonade. And it might sound stupid to you, but for every company that I've looked at that got involved with SoftBank, they all went south. This involves Renren, Uber, WeWork, Slack. All of these companies I was looking at, public and private, and they all seem to be going weird when SoftBank started getting involved. So I think SoftBank, this is my interpretation here, don't sue me here. I think SoftBank infuses a shit ton of money into a problem that they think has a lot of potential. This in turn turns a niche business that was doing very, very well and forces them to grow way too fast. It doesn't look like most of these businesses know how to scale up in a safe way. There's actually a really common saying in the tech community, and it says that a $1 million company CEO cannot grow a $100 million company because the way you approach your business is very, very different. You might be very, very successful in going from zero to $1 million, but when you're trying to grow your business from $50 million to $100 million, it is a completely different game. And so this is what I see as the SoftBank problem. And this is my additional concern about Lemonade's success, and therefore I'd rather put my money somewhere else. All right, guys. I hope this analysis made sense for you guys. Let me know if you have any questions or concerns, and if you have any requests, please leave a comment as well. Share this around so that we can grow this community together. If you haven't done so, please hit the subscribe button, and I look forward to working with you next time. Thank you.